A systematic investment plan, SIP, allows you to invest a fixed amount regularly in mutual funds. This disciplined and flexible approach helps you build wealth over time by leveraging the power of compounding and rupee cost averaging. Here are 20 effective SIP strategies to maximize returns and grow your wealth. 1. Equity SIP. What it is: investment in equity mutual funds which are linked to the stock market. Risk level: high return potential. High, 12 to 18% annual returns over the long term. Ideal for investors with a long-term horizon, 5 to 10 years, and a high-risk appetite. Tip: choose a diversified equity fund to spread risk across sectors. 2. Debt SIP. What it is: investment in debt funds including government bonds, corporate bonds, and other fixed-income securities. Risk level: low return potential, moderate, 6 to 8% annual returns. Ideal for conservative investors seeking stable returns with lower risk. Tip: ideal for short to medium-term goals like education or emergencies. 3. Hybrid SIP. What it is: a combination of equity and debt in a balanced proportion. Risk level: moderate return potential, 8 to 12% annually. Ideal for investors seeking balanced risk and return. Tip: suitable for medium-risk investors with a 3 to 7-year time horizon. 4. Large Cap SIP. What it is: investment in large, well-established companies. Risk level: moderate return potential, 10–14% annually. Ideal for risk-averse investors looking for stability and steady returns. Tip: ideal for beginners as large-cap funds are less volatile. 5. Mid-Cap SIP. What it is: investment in medium-sized companies with higher growth potential. Risk level: high return potential, 12 to 18% annually. Ideal for investors comfortable with higher risk for potentially higher returns. Tip: suitable for long-term investors, 7+ years, seeking aggressive growth. 6. Small Cap SIP. What it is: investment in small emerging companies with high growth potential. Risk level: very high return potential, 15 to 25% annually. Ideal for aggressive investors with a long-term horizon. Tip: diversify with large-cap funds to balance volatility. 7. Sectoral SIP. What it is: investment in specific industries like technology, healthcare, or energy. Risk level: very high return potential, variable, 20% plus if sector performs well. Ideal for investors with knowledge of specific sectors and high risk tolerance. Tip: avoid overconcentration and invest only a small portion in sectoral funds. 8. Thematic SIP. What it is: investments based on broader themes, e.g., ESG, digital transformation. Risk level: high return potential, 12 to 20% annually. Ideal for investors who believe in emerging trends and innovation. Tip: monitor the theme's performance closely and diversify across themes. 9. ELSS SIP, Equity-Linked Savings Scheme. What it is: tax-saving equity mutual funds under Section 80C. Risk level: moderate to high return potential, 12 to 16% annually. Ideal for investors seeking tax deductions up to R1.5 lakh per year. Tip: stay invested beyond the 3-year lock-in for better returns. 10. Index SIP. What it is: investment in funds that track market indices like Nifty 50 or Sensex. Risk level: moderate return potential, 10–12% annually. Ideal for passive investors looking for low-cost and market-average returns. Tip: ideal for beginners due to low expense ratios and consistent returns. 11. International SIP. What it is: investment in global markets through international mutual funds. Risk level: moderate to high return potential, variable, 10–20% annually. Ideal for investors seeking geographical diversification. Tip: diversify across developed, US, Europe, and emerging markets. 12. Dividend Yield SIP. What it is: investment in companies that pay high dividends. Risk level: moderate return. Potential 8 to 12% annually with regular dividend payouts. Ideal for investors seeking passive income alongside capital growth. Tip: great for retirees or those needing regular cash flow. 13. Dynamic Asset Allocation, SIP. What it is: funds that dynamically adjust equity and